If you're interested in knowing about the interest rates and buying a home in today's market, then this podcast is for you. I have Alex Merrill, local lender, here today, and he's going to answer all your questions and kind of shed a light on what's going on in the market. So, Alex, welcome to my first ever podcast, by the way. I'm super excited to have you here.
Very, very excited to be here.
So tell us a little bit about what is the market doing right now?
So the market is moving all over the place. It's a little bit chaotic, not to scare anyone, but it is a little crazy right now. I think the biggest thing that everyone's focused on is the feds, although the feds aren't necessarily tied to a mortgage, and we can get into that a little bit later. But all eyes are on inflation, the stability of the economy. There's a lot of different factors that are going into rates and mortgages and so on and so forth.
Well, so I know, obviously, I saw last week that the feds raised the rates, and I'm not immune to getting upset about that either. You know, it bummed me out for a minute, but then I remember I called you and I said, what does that mean? So can you explain to everybody kind of what you told me and what that means?
Yeah, so the Fed funds rate is an index typically for short-term loans. And those short-term loans would be stuff like your car loans, credit card rates, other short-term indexed home equity lines of credit. Those are shorter loans than your typical 30-year fixed mortgage rate. And although mortgage rates may trend the same way, they aren't necessarily dollar for dollar. They don't always move with it. And when we saw that quarter increase from the feds, our mortgage rates actually improved. We kind of factored part of it in, and then really more than ever with media and with the speed of information, the Fed chairman, Jerome Powell, they really analyzed his speech, and from the tones of it, saw a positive impact. So from that, mortgage rates actually improved and were getting better or lower.
Crazy. I always find that so interesting because I've been told that when the news comes out, if it's what they expected, then the rates stay the same. But if it was not, if it was crazy what they didn't expect, they could go up. But in this case, they stayed the same or went lower. So something that the media is making seem so crazy bad was actually a good thing for us.
Certainly. And then the power of the media has really come into play. We've really seen the last 2 or 3 years with the different adjectives they use on explaining a simple thing. If they keep it a little bit mysterious, the market might swing up or down for a few hours, but then at the end of the day, nothing has changed. It does a lot of fluctuations. So I say it's a little crazy in that sense, but really this is our new norm. And with the way things are moving, it's really not that bad.
I know, because all the buyers right now are saying, oh my gosh, it's in the 5%. While that is more than the 2 3/4 that a lot of people were getting, historically 5% interest rates are still great rates.
It's definitely it's a good region to be in. Now, we were very spoiled for a few years with that 2.5, 2.625, maybe 3.25. When you got a 4%, it was kind of like, oh, a 4. What are you talking about?
You must have bad credit.
Yeah, and now we're kind of in that 5s, maybe a little bit of 6, depending on the program. And although because it was so short, or wasn't that long ago when we had those lower interest rates, this is kind of more of a norm.
A normal market.
A normal market, definitely.
Well, speaking of the interest rates and just trying to get people that were looking at the 2 3/4 and the 3% to kind of get them over that hurdle into these current interest rates and helping them get a home, what kind of programs are you guys using to help people get into the homes?
So there's a bunch of different programs, and really what it comes down to is the comfort of the buyer. Now, interest rates are going to go up and down. They're going to change. They're based on the bond market, so they're constantly changing, kind of like your stock that you maybe have your Facebook stock, whatever it may be, that's constantly changing. Well, interest rates are kind of fluctuating the same, and it really comes down to what that comfortable payment is. And so some of the things that we do to help the buyer with a comfortable payment is a 2-1 buy down. And simply it's usually best when you have a seller that helps you. So they give you a credit, and you use that credit in a escrow account. And each month, a little bit of money from that account will go in to help that buyer have a more affordable payment. And the 2-1 part comes in where it's a 2-year thing. So let's just say your rate is 7%. Now the first year it's going to go down 2%. So it's going to be a 5% rate. And then the second year it'll be 6. And then after that, it'll be back to 7, which is what the rate was.
And that's for 30 years.
And that's for 30 years. And it's that payment acts, the money comes from the escrow account to make the payment act as if it were a 5% rate or a 6% rate. So it's just a mechanism to help the buyers have a more comfortable payment if the seller is willing to help. And in recent market, we've seen inventory be a little bit less, the interest rates really kind of slowing the idea of buying down, although the market's still hot. There's still a lot of movement, but it's not, 2020, 2021, we had this crazy rate of movement, and that kind of became a short-term normal. We're now realizing this is the normal, and something like the 2-1 buy down really helped buyers, or has in recent helped the buyers with that comfortable payment.
It's interesting because I didn't realize that's how it worked. I remember when I asked you the first time, I thought the buyer could buy their rate down or the seller could buy it down. But I remember you said, well, it wouldn't really make sense because it's just essentially a savings account that the buyers are drawing from each month, $400, $500 a month, whatever it is, to make the payment as if it was that lower rate. So
Definitely.
That made perfect sense to
me. And to your point, though, you could buy the rate down, so you could utilize both of those strategies, whether you buy the rate down for 30 years or you utilize that credit to do a 2-1 buy down where the payment acts as if it's lower. And everyone's different. Every situation's different, where maybe that they never want to touch it again. And that could be the beneficial program versus a 2-1 buy down. There's a few different avenues, but every client's different and their situation's different.
For sure. I wanted to talk a little bit about the 7-1 and the 10-1 adjustable, the ARM program. Those seem really exciting to me, and I've been speaking with my clients about that. Can you tell us a little bit about how that works?
Certainly, yeah. So the 7, the 7 and the 10, we'll just talk about the 7 for now. It's amortized over 30 years, so it's kind of like the 30-year fix, but the rate is fixed for the first 7 years, and then after that it'll adjust. Now the goal of it would be to refinance within that 7-year period, but in the current market, those programs, the rates are a little bit lower than the typical 30-year fix. So some clients are able to take advantage of that lower interest rate for the first few years. And every situation is different, but some people might buy and move in the next 5 years or so, so that they're not even worried about refinancing. Now, if interest rates change in the next year or two, even better, and it's cost effective for them, we'll refinance them and kind of restart that clock. But they're able to take advantage of that lower rate. And the same thing for the 10, it's just 10 years instead of 7.
Well, it's interesting because most people, they say, I'm going to stay in this house forever. I'm never going to move. And the reality is most people within 7 years, they're either refining, pulling money out, and they're adding on to the property, or they're moving. A lot of times you get a transfer or you have a baby or something happens and you don't stay in that home. So and how much of a better savings of interest rate, say on that 7-year adjustable?
It'll depend on the loan amount, but around 0.25% to 0.5% difference, which could be a significant amount in a monthly payment, depending on what you're buying.
That's great.
And with all of those, like you said, life events happen. So you might buy this as be your forever home, but things occur, and
typically
you might move, you might grow out of your current space, you might want to move to a new area. A lot of unknown, and it helps you at least lock in a lower payment for that first 7-10 years with the idea that, hey, we're going to be refinancing if it's cost effective for them.
So as a new buyer right now, and my kids are that age range for new buyers, so all of their friends will come around. They say, so Sharon, what do we need to do? What do we need to do? And I told them I will be making a show for them. So guys, here it is.
Listen up.
Take note. So what would you say the first step? I always tell every buyer, you just got to talk to a lender first because it is payment driven. Sometimes they think they can afford more, but then they see the down payment. So for a new buyer, what's their first step in the loan process with you?
The first step is having a conversation with the loan officer and really going through all of your items. And when I say that, it's figuring out what your budget is, figuring out your income, where your job. I just lost my train of thought. Excuse me. It's really getting organized as a buyer. So with that, we're looking at your tax returns. We're looking at W-2s, pay stubs, bank statements, looking at your credit. Some buyers they don't know that we're looking at their gross income. They're
net.
They're thinking they're net. Or, hey, I was a W-2 employee forever. Now I'm a 1099 self-employed. Well, that's a different factor. So starting that process as early as possible to help you be prepared is really, really helpful. And on top of that, I help clients go through a budget and what they're comfortable paying on a monthly basis, which may let them know, hey, this is a good time to buy for me, or I need to wait a little bit and do a few different tweaks here to make sure that I'm ready. And I mean, if someone wants to buy next year, a lot of times they end up buying in 2 to 3 months. They don't
almost always.
They never wait. But getting started early is really beneficial because sometimes, let's just say they had a credit card that they forgot about a year ago. Well, it's probably been hurting their credit report. When we go through that, we find that and we can repair that. So if it
takes time to do that kind of stuff.
It definitely takes time. And if in a few months, that's when they're going to be purchasing, we might have that credit fixed by then. But if you wait till the last minute, you're hurting your chances of doing that.
I find it so interesting that most buyers, no matter how educated they are and how much, they hear out there that they need to do this in advance, they're just reluctant to. I think sometimes they're just afraid of what they're going to hear and they wait. And I just had the situation happen. I mean, I have it happen all the time where they wait because they're taking their time to figure whatever out that they need to figure out. And then they see a house. Unexpectedly, this house pops up. It's their dream house. They want it. And now we're jumping through hoops to make things happen. And it's stressful. It adds a ton of stress to the transaction. And a lot of times they don't get that house because they're just not in the position to be able to do it. And so I tell people you can save all that stress if you think you need to start here, 6 months ahead isn't a bad time to start. It can, right? I mean,
no, totally. And some clients start a year in advance. I mean, because certain things like figuring out where your down payment's going to be coming from, if it's a gift from a parent, setting that up, getting that ready. If a parent needs to co-sign in some cases where maybe their income isn't as strong as it needs to be, and we need to kind of make sure that that's all in line. That there's multiple factors, multiple things that can happen or that will need to happen. Every transaction, as you know, is very different.
Well, I tell people it's kind of like if you had a lawsuit for $600,000, $800,000, $1 million, $1.5 million, you wouldn't just walk into the courtroom not prepared. You would take the time, you would meet in advance because you have this big dollar event. It's no different when you're buying a home. And I find that the more prepared you are, the better price you're going to get on the property, the more knowledge you're going to have, and the better transaction you're going to have because you're not so stressed out. And one of the things you mentioned that I appreciate so much in you as a lender, a lot of lenders, you go to them and literally they just want, tell me how much you make, give me your tax returns, give me your check stub. This is, here you go. But you're more of a financial and loan person because you're looking at the whole picture and seeing, hey, what can you really afford? Sometimes people are really aggressive with what they think they can afford, but sitting down and giving them that information and going over it with them in advance, I think makes a big difference. So
I appreciate that. Yeah, no. And with that too, a conversation that we have today might not be relevant in 2, 3, 6 months because the market's changing. Rates are changing, so that affordability or that payment is changing. So we kind of always start with a ballpark and then adjust as we see homes.
It's kind of a range or something.
I mean, who knows? Maybe in 6 months rates will be back in 3%. Now it's not
I'll put out that pixie dust. So along those lines, I'm seeing the market heating back up again for the buyers. It seemed like the beginning of January, there wasn't much going on, which is pretty typical. But showing property the last couple weekends, it's, the open houses are crowded. We're seeing the multiple offers. So in that line of thinking, I'm letting my clients know you should get pre-approved if you can up front, because then you're going to come in and essentially be a cash buyer, and we're competing against a lot more cash offers. People with the higher interest rates, the families coming out of the woodworks giving them cash so they don't have to get that, horrible 5% loan. So what time frame are we looking at, and can you do a pre-approval so that they're essentially a cash buyer?
Yeah, so I think there's two parts. There's definitely the pre-approval, and I think what you're talking about is more like the pre-underwritten loan.
Yes.
So you're really taking the questions out. We call it a TBD approval, and we submit the full package to the underwriter. They go through.
So like TBD, like address to be determined.
Yes, exactly. The TBD is the address. The underwriters will go through everything. They'll check all the boxes at that time, go assets, look at all your income documentation, and then essentially approve it. You start looking at homes. That file will go directly back to that same underwriter the next month or the next week, whatever it may be.
It goes back to the same person. Oh, yeah, that's great.
It goes back to the same person. So they've already reviewed it, so you can move very, very quickly and meet those timelines, especially when the market is very competitive. And I would agree with you. It's definitely heated up. It's awesome. I think everyone really enjoyed the holidays and
took a break.
It took a little bit of a break. They got all of their holidays with the kids, the school breaks,
all the trips. Everyone took trips.
Everyone was out
except for me. I stayed home and worked. I think you were on some fun trip, but I stayed home and worked. Yeah, I think it is heating back up, and what I tell my clients is have everything in your arsenal, so to speak, at your disposal, because maybe you get a seller that doesn't need any of that. They don't need you to make it essentially a cash offer, or they don't need you to shorten the time frames. But if they do, and they've already pre-done all this with you, then they have the options of being able to do that. So definitely. I think that is good. So pre-approval, and so basically, I think you already mentioned, what documents should they have ready to give to you when they're going to speak with you?
So the typical documents for a W-2 employee would be 2 years tax returns, 2 years W-2s, 1 month recent pay stubs. Sometimes we'll ask for the year-end pay stubs for the last 2 years if they have bonus or commission income, because we average that income. Okay. Then we ask for 2 months bank statements or quarterly statements for their stock and retirement accounts. And then part of that process too is to run their credit. Now with the pre-qualification, it's typically a soft credit pull, so it's not always a hard credit. Shouldn't affect it. And that is a big myth, I think, and kind of scary for some first-time home buyers, is having their credit run. It seems that people have heard that there's this mysterious thing that your credit's going to just tank when you run it. And they are actually designed to be run a few times.
Without getting this huge decrease in your score.
Definitely. And especially when you have a short period of time. So if you have your credit run twice or 3 times within a week, it's designed to do that. Now, if you run your credit twice every month or every other month,
they think you're trying to get credit somehow.
And you may be struggling somewhere, and so that credit score is going down when you're running it that often. But they are typically made to be run a few times.
Well, and also, can you touch on, I'm trying to think of the questions that most of my first-time buyers have, like points. Can you discuss a little bit about what a point is, and are most of the loans having points these days, or where are we with that?
I think it depends on the situation. I'm sorry I keep saying that, but with points, so real quick brief on what a point is. 1 point is equal to 1% of the loan amount added to closing costs. And that's used to either buy the rate down, or sometimes with investment properties, they might not have a par rate or a no point rate. So you might have to pay 1%, 1.5%, just to get that loan. And
because there's more of a risk with that property.
There's different risk, valuations there. And as far as if it's beneficial or not, it depends on the situation, because let's say you have a property that you plan to stay in forever, or you maybe want to live in it as a primary residence for the next 5-6 years, and then maybe start doing short-term rentals, whatever that may be. If that payment isn't where you want it, you might utilize, and you have extra cash, you might utilize that point to buy the rate down from a 5% to maybe 4.5%, and that might be a big jump, but maybe from a 5% to 4.75%.
Which changes the payment like every little bit.
Yeah, every little bit will change the payment, and again, unfortunately every situation is different. So that's also one of those conversations that you have with your lender in the beginning of your pre-qual, your comfort, trying to find that comfortable zone with your monthly payment, and that will come back to you, to your realtor or trusted realtor.
It always translates, whatever that price is going to translate into an area or certain bedrooms, bathrooms of a loan, that kind of thing. What typically are you seeing more people getting fixed rate or adjustable right now?
Right now, I'm actually seeing a lot more people with a 30-year fix, and I think
the adjustables still scare them.
The adjustables still scare them, and I will try to talk as much about it but some people are set on, hey, I'm not touching this thing, I'm not leaving, and they'll call me in a year or two and be like, hey, can we refinance?
Can we get an adjustable? Well, it's true. If I even bring it up, most people are like, whoa, like, don't even bring up an adjustable mortgage to me.
Totally.
So,
I mean, if they're willing to listen, which is not always the case, I think the 7 and 10 years are phenomenal products, especially now where interest rates are a little bit higher than what they used to be. It's a phenomenal product, and ability to save a little bit extra for the next few years. And the beauty of it is, let's just say in a year or two, rates do decrease even more. We can totally refinance, and you can put them in a 30-year fix at that time, or we can do another 7-year or 10-year. It all depends.
So the questions that I get from most of the first-time home buyers, number one, what's the least amount that they can bring in to make a purchase?
So there's multiple programs. The least amount is a 3% conventional loan. Okay. There's also a 5% conventional loan, and then the 3.5% FHA. Okay. Those are the typical first-time home buyer minimum down payment kind of programs. There's the best program out there, and thank you to all of our vets, is the VA program, because you can get in with 0 down.
If you're a veteran, you're going to be happy with that one.
Yeah, they thank you for your service again, but that is the best loan out there. And I think in the past there was some extra paperwork, there was some liability to the seller, which is pretty much gone. And I think those buyers or those sellers that were looking at those were scared of those loans, but they had
a really bad reputation. I remember years ago, if a VA offer came in, people would say, oh, no, we'll take this over that. And I would say, well, first of all, they're veterans. Again, thanks for your service. Let's help the veterans. But they're backed by the government. And, it used to be like the CHAFA loans or the CalVet loan. There were some different loans that did have a little bit more criteria and liability. But I've never had an issue with the VA loan. No. And we always push when we can to help them get in a house.
Certainly. And they're honestly one of the safer loans because they're backed by the VA. And interest rates are phenomenal. They can go in with as little as 0% down.
But I hear when they do put money down, then they get an even better rate, and some like the funding fee goes away and things like that.
Definitely. Yeah. There's some benefits to that too.
So you mentioned, which is the other question I get most often, is what kind of first-time homebuyer programs there are. And I know from my experience, while there are some out there, they're typically like a bond program, and there's super strict criteria, and most of my clients never meet that criteria. But they get excited about it, and then I have to break the news that you don't fit. I think the newest one we heard, not only do those buyers have to be first-time buyers, but their parents had to have not ever owned a home either. So, which I don't know how they're going to find all that information out. But so have you heard of any good programs out there, or what are you hearing?
Yeah, there are a lot of first-time homebuyer programs, and I get a lot of calls about them. And I always have buyers that are really set on, hey, we really want to utilize these different grant programs. And I say that's great. And when you actually boil it down, 90% of the time, they don't fit that very small box of qualifying for.
Because a lot of times it has to be in a not a bad neighborhood, but maybe a neighborhood that's a little less desirable, or because they want to build up some of these neighborhoods so the governments will throw some money into some
Sometimes
programs.
it's zip code driven, and with those zip codes, there could be some income caps, and there's kind of this perfect zone of income limits. Well, you can't make too little, but you can't make too much, and sometimes, most of the times, that areas where those are, the buyers don't want to be there.
Yeah.
Not yet.
And if it's income related, they're not going to be able to qualify in Southern California for where they're looking for
Definitely.
So would you say then most first-time buyers are doing those 3 and 5% downs?
Yeah, I think a lot of the buyers that I talk with, they may start with those down payment assistance programs, looking at the CalHAFAs, the GSFA, multiple grant programs, and then they find that they might be a little bit more expensive than they thought. And when they're able to just put 3%, 3.5%, 5% down, they're in a much better spot. Their rates are still very, very good with those first-time homebuyer programs. Now, the other part of that too is mortgage insurance. People are terrified of this mysterious mortgage insurance. It's really it could add maybe $50, $100, $200.
But to back up, that is anytime you're putting less than 20% down, a lender will typically, certain programs not, but they'll typically require mortgage insurance.
Correct.
So that's what you're talking about.
Correct. Yep. And so when you put that 5%, 3%, 3.5% down, you'll have mortgage insurance. And it's there because that file is looked at as a little bit riskier because the loan to value ratio is high. So the bank or whoever may look at it views that file as a little bit more of a risk adverse file.
Because if something happened and they didn't pay their loan and they got it back, it's not 20% down. So if the market went down, they would lose money.
Exactly. Yeah. If the market, not that it's going to crash anytime soon. There's a lot of bad media about that. It's not going to.
That's a whole nother show. But we can go there.
But it's there as a safe point, and the mortgage insurance it may sound scary, but it's really
just part of getting the loan.
It's part of, and that's also goes into going back to getting prepared and seeing or learning everything that goes into play with that payment, so that when you are looking at homes, you walk in, you're comfortable knowing, hey, I can afford this. I'm not going to be, or maybe on the top tier of, this is maybe a little bit of a stretch, but it's worth it. And what?
I always like to boil it down to also like every $10,000 is X amount. Sometimes it's $60 or $70 or $80 a month, so that when you're in the countering phases, exactly. If it's $20,000 more and it's $60 every $20,000 or every $10,000, you're at $120 more. Like, you could just not go to Starbucks. And make
the Starbucks factor is always
that's
huge.
a pretty big one.
Yeah.
Why does everyone always boil it down to Starbucks? But we've been doing that for years. We just
definitely. It is crazy how much you will save by making coffee at home.
It is true. I do go to I have my favorite places, but I try not to go every day. So, all right, we covered a little bit about the first-time buyer program. The other thing that I always like to touch on is, if there is a potential for a gift, for people, if you're starting out way in advance and you have the time, have the conversation with your family. There's some people that you're going to get an inheritance. Maybe they'd rather see you use it up front, and while they're still alive. So I'm seeing, and I don't know, I was going to ask you, but I'm seeing a lot more gifts in the marketplace because parents really want to help their kids, and they know that it's a high price, but then they see the benefit, obviously, of homeownership.
Definitely. And I think times have changed in the last 40, 50, maybe 60, 40, whatever, many years. Can't count today. The market has changed, and that ability to get into a home requires a little bit more. And if your parent, relatives are willing to help, and more are, to get those first-time home buyers into homes, because there are so many benefits to being a homeowner versus paying your landlord's rent or mortgage.
Yeah, for sure. So is there any upfront fee? If someone's going to come to you and they want to talk about getting a loan, is there any upfront fee that they have to pay?
Typically not. The only fee that, and we don't charge it, is a credit report fee.
Usually that just get a loan.
Some lenders may charge it, and depending on where you are, but no one around here that I am aware of does. But in the book, it says that could be an upfront fee that you could charge. But no, the simple answer to getting pre-qualified doesn't cost you anything.
And I always tell people as well that there's such a benefit. If you're going to shop, do your shopping, but then align yourself with one lender. Totally. Because you want to now have that person that you can ask all your questions, have that direct communication with, and that's going to guide you through.
Yeah, and I think with the relationship that you have with your lender is more than just a rate, because you're making a huge decision. You have the realtor and the lender have to really work together with these clients, and if you don't have a relationship there, it's going to be difficult to, and if you're new, it's going to be difficult to understand what's going on. There's a lot of paperwork, there's a lot of moving parts, and it's always fun looking at homes, but when you boil it down, there's a lot more to it than just looking at properties.
I always tell people it's all fun and games until you find a house. Yeah. And people will be like, yeah, I'm good. I'm not that, it's fine. I don't get super emotional about things. Don't worry about me. And then I watch their face when they see the house. Like the energy in the house changes and you can tell like, okay, they like this house. And it's almost like sweat starts dripping down their face. And you could see there's typically one more than the other that's more about the payment and the whole process. And it just stops people in their tracks. And you can't know that feeling until you get there. Totally. So that's one of the whole reasons that I wanted to do this talk is it's not scary. It doesn't have to be scary to get pre-qualified. Like Alex is a nice guy. Like he's not going to hurt you. And to get that, first of all, it feels good because it's the hardest part of it. I find that the most reluctance buyers have is talking to the lender. It's like they're afraid of the finances and what they're going to find out. But once they do, they usually say, oh, that wasn't so bad. Like, I know it's not that hard. And then you can just build from that and being able to save money and being able to choose the different loan program you want and have that time up front. Because when you do it the opposite way, you find a house and now you're trying to get the loan. Well, you combine that with a purchase contract and inspections and timeframes and it's just overload.
Yeah, there's a lot that's going in a short period of time, especially in a competitive market where your contingencies, your escrow periods are being shortened. So when you do find that you walk into that house, you have that feeling, you realize what you missed out or all the work that you're procrastinating you need to get done.
And everyone says, I wish I would have done that.
Yeah.
Like, I know, it's all right. We still got you. But I think you can't make a better decision than to start that earlier. So I know I threw a bunch of questions at you. Is there anything that I didn't touch on that you think is important for a buyer out there to know right now? And maybe not even just a first-time buyer, but if someone's looking to buy a second home or, what about the interest rates or the mortgages?
I think one of the things that everyone should know is not really to pay attention too much to the media in as far as where the market is. I think in the last year with interest rates rising, there's still tons and tons of deals out there. There's plenty of homes out there. The rates are where they are right now, but they have that corny saying, marry the home and date the rate.
It took me a minute the first time I heard that, but I was like, wow, I like that.
And really what that boils down to is there's not a bad time to buy if you truly love the house and you can make that payment happen, because the interest rates can change 6 months, a year, they can go down, it can be more affordable. But if you can make that first 6 months at a little bit higher interest rate, a little bit higher payment, then you're in the home that you want.
Mm-hmm. And most people, I remember when I bought my first home, it's scary and you think, oh my gosh, I'm not going to be able to do it. But you just, as long as you're not completely overextending yourself, you give up the Starbucks or the things that you need to give up, and they almost always come back because you find a way to make it work. And, if you think right now, 10 years ago, people that, I want to buy, and it didn't, they'd be looking back, kicking themselves because where the market is now from 10 years ago. It's going to be the same 5 years from now. People are going to look back and say, oh, why didn't I do it then? So I think every market has a market within a market too. If you're looking for a good value and you're getting the best loan and you have people that are looking out for you, I think it's a no-brainer to
definitely. And again, the market is hot. There's a lot of stuff going. There may not be as much inventory as it used to be, but there are still plenty of homes out there, beautiful homes. And
price they've come down a little bit in price.
Prices are adjusting, yes.
And that's what I was looking at a little bit before too, is seeing, if you bought at a higher price, it's a lower interest rate versus now the little bit higher interest rate and the lower price, you can always refi and get a different rate, but you would never have been able to get the lower price. So I think people are...
It all evens out at the end of the day. And I think that's the biggest thing is don't let the media scare you and say, oh, I need to wait for this big crash because it's not coming.
That's true. Well, thank you so much. This was really fun.
Super fun.
We'll do a stage 2 or whatever you would say. What is it? The next movie, the sequel to this next time. So thanks so much.
Thank you, Sharon.
Bye.